And at this point in time, we are going to have a discussion about the future, connecting the long-term care and organic life settlements. And I will let Michael Friedman define organic, because he has coined that phrase for us as he does his talk. And our speakers are Michael Friedman, Chris Orestis, and Rob Haney.
Hey again, I'm Michael Friedman, Senior Vice President at Coventry. I'm going to do a little bit of moderating and also provide some insight into what's happening in this development of policy conversion or long-term care life settlements for long-term care. But let me introduce Chris Orestis, who's the co-founder and president of the Life Care Funding Group. Chris is an innovator and an entrepreneur and the leader in the new market for life insurance policy conversions for long-term care. Chris is doing all of the right things as this market is turning its attention and its focus on the smaller face, short LE policies, Medicaid, and he's doing so because he's focusing on the consumer. He's attracting investment. He's reaching out to partners across the healthcare and consumer advocacy organizations, and he's doing an excellent job at public relations. We also have Rob Haney, who is the owner and managing director of Life Insurance Settlements, Inc., a longtime member of the industry, member of the LISA board. I read his bio. It says, quote, a major influence in the evolution of the life settlement industry.
I think you wrote that one.
He's long in the tooth, and we're really grateful because as the market is emerging for this new era, this new focus, and the thing that Alan spoke about, back to our future in many ways, looking at the old viatical market, but Rob's seen it all. The viatical market, the life settlement market, and now what we hope will be and what he's going to focus on is an opportunity for both the life settlement and the traditional, the old model viatical market to thrive. And so we're looking forward to hearing his presentation. We're going to start with Chris, and then I'm going to give some update, and then Rob will take it from there.
Well, thank you, Michael. So this is the first time I've ever been to a LISA conference, and it's really nice to meet many of you. And the very kind things that Mr. Berger was saying this morning, that introduction, I didn't know anybody was really paying attention to us. So this is really a pleasant endeavor for us to be here, and I appreciate the opportunity to come and talk about this. I am Chris Orestis. I'm the CEO of Life Care Funding. We started the company over 5 years ago, and the mission of the company is to help seniors and their families access private pay options to pay for long-term care. Now, a transaction that we have innovated and specialize in to help seniors and their families do that is what is known as the conversion of a life insurance policy into a long-term care benefit plan. And as Mr. Berger said earlier, it's no secret. The situation in this country, the crisis situation in this country when it comes to funding long-term care has been something that has been talked about for years, decades, since the inception of Medicare and Medicaid under Lyndon Johnson. But truly, when that crisis really came into light was 2 years ago, January 1st, when the silver tsunami crashed on the beaches of the United States of America. And that is 75 million baby boomers who started turning 65 at midnight, January 1st, 2011, at a pace of 10,000 a day. That is 10,000 people a day automatically qualifying for Medicare and Social Security, automatically being funded by taxpayer dollars to help assist their senior years. Part of that rubric is also Medicaid. Medicaid was never intended to be what it is today, but today it is the default payer of long-term care in this country, and there's an entire system built to move seniors onto Medicaid in a variety of ways, which we'll talk about as we go forward. part of what's exacerbating this issue, and it's ironic because I remember I actually used to work for the Health Insurance Association of America, and I used to work for ACLI in Washington, D.C. I was a senior lobbyist for both organizations. And I remember back in the late 90s and moving into the 2000s, the anticipation of this day, of when the baby boomers were going to hit, and the incredible amount of long-term care insurance sales that were going to happen. Ironically, it went in the opposite direction. In 2000, there was almost 100 active long-term care insurers. Today, there's less than 2 dozen. Companies like MetLife, Prudential, Unum, Guardian have all quit the market. I mean, MetLife quitting the long-term care insurance market because they can't make it work is like General Motors stopping to selling cars because they can't make it work. I mean, it's unbelievable. And that was going to be the big private market fix for this country. Seniors were going to buy long-term care insurance, and that was going to help offset the pressure on the public dollar system. It's gone the opposite direction, and now there is a push, a almost frantic push in the states and in Washington, D.C. to look for private pay alternatives. What are the alternative sources? If it isn't going to be long-term care insurance, and if home equity has diminished significantly in this country, what's it going to be? Well, for the people here, we're talking about a massive asset pool that is out there, available, and owned by these policy owners. 153 million Americans own close to $30 trillion worth of in-force death benefit. By comparison, there's $10 trillion of home equity today in the United States. The average death benefit, though, is $172,000, which is more in the size of that middle-class, middle-market policy owner that we work with. Our company tends to see people coming to us with a need for long-term care, not that are high net worth and not that are truly at poverty level. It's your middle-class American. That's the person who's struggling with paying with long-term care, and that's the person who owns a life insurance policy, $50,000, $100,000, maybe $200,000. That's a big policy in that middle-class world. And they are abandoning those policies by the billions every year because the system is designed to ask them to do that. Please get rid of your life insurance policy so we can put you on the government assistance quicker. Now, the cost of long-term care is significant, and it'd be significant for anybody in this room. If you're going to go into assisted living, that is a private pay environment. Medicare, Medicaid does not cover assisted living, and that can cost $40,000 a year out of pocket cash. If you're going to go into a skilled nursing facility at the private pay rate, that's double that. Home health care, significant. Alzheimer's care, one of the fastest growing causes of long-term care need, Alzheimer's, extremely expensive for a family to take on. Again, high net worth, you've probably made your plans, you're probably in position to handle this. Poverty level, you go right on to government assistance, but that big middle-class bulge, that's who's struggling. And that's who's driving the Medicaid crisis. States, every state in this country, their biggest budget item is education. Their second biggest is Medicaid. And Medicaid is a crisis situation in state after state after state. 2009, you had $240 billion of long-term care reimbursements under Medicaid. Within 2 years, that had almost doubled. 10 million people a year are accessing long-term care services. And according to Government Accounting Office, when they look at assets that are used or could disqualify somebody from Medicaid eligibility, a life insurance policy is owned by as many as 38% of Medicaid applicants. And the vast majority, 37.9% of that 38% are either surrendering or lapsing those policies to go on to Medicaid. That's a major problem from the standpoint of the provider of long-term care services because they are confronting cuts constantly. Last year, they got an 11.1% across the board reduction in their reimbursement rates. Now, when they get a reduction in reimbursement, they don't get to reduce their services. If it's mandated that they have to keep the hallways heated at 75 degrees all winter long and oil is going up and their reimbursement's going down, too bad, figure it out. That's the answer of the government. Just you have to, these are the rules, you live by them, or don't turn to us for any reimbursement. Now, as I said, life insurance is an unqualified asset for Medicaid eligibility. What the long-term care benefit conversion does is take that policy and instead put it in a very specific configuration so it will be a Medicaid qualified spend down of the asset. So somebody who would use this conversion program that we work with people around the country to do, instead of abandoning the policy, they're turning it into something that is specifically set up to be spent down on a monthly basis, and when they're done, they go on to Medicaid, which is driving some of this interest at the state level legislatively. Now, for the consumer, the good news is the bad news, and the bad news is the good news. A life insurance policy is an asset, so that's why it counts against them for Medicaid eligibility. But because it's an asset, it has a market value, and they have the legal property ownership right to access that market value and convert that policy. So it was back in 2009, the first time we sort of seemed to pop up on the radar screen with this little concept that we were trying to see if it would work. Conning and Company published their annual life settlement report, and we found ourselves in it. They had started talking about this convergence of interests between the policy owner, the long-term care service provider, and the states. The fact that this dynamic of life insurance policies could potentially be a way to delay entry onto Medicaid and put more private pay dollars into the hands of the providers of care, which they very desperately need. Their prediction was that it wouldn't be too long before action at that government level, particularly at the state level, to see how we might be able to start moving people in that direction to help create Medicaid dollar savings. Within a year, the beginning of that became reality. When NCOIL passed the Life Insurance Consumer Disclosure Model Law, they specifically included what we're discussing here today, the conversion of a life insurance policy into a long-term care benefit plan. So what is that? Well, it's a transaction that is regulatorily compliant to the secondary market regulations, follows secondary market regulatory framework, but is configured in how it is, the benefit itself is set up and administered to be a Medicaid qualified spend down. It's a very unique dynamic to put those two things together. Not easy to do, but something that we've been doing to help anybody with any form of life insurance. We have worked with term life, we have worked with group life, we have worked with whole life, we have worked with universal life, to convert those policies into something that will fund any form of long-term care. Unlike long-term care insurance, which has a number of restrictions on the kind of coverage it will provide, this is at the direction of the consumer. They convert their policy, they can then direct their benefit on a monthly basis to pay for home health, assisted living, skilled nursing, whatever it is that they require for legitimate long-term care services. But that money is only spent for long-term care services. They cannot use it for anything but a approved, typically default is Medicare, Medicaid recognized form of long-term care service. Our company primarily works with the consumer directly. They are calling us. We've never run an ad. We've never really worked with brokers. The consumer hears about us, finds out about us. Oftentimes, they're referred to us by nursing homes, assisted living communities. This is a sample of some that offer our program as a funding alternative to families who are looking for care, and the life insurance policy pops up as something that is in play. What has been interesting to see in the last year and two is how advocacy organizations, the American Healthcare Association, the Assisted Living Federation of America, AARP now, in support of this as a public policy initiative and as something that the constituencies that they represent should be aware of and should be accessing to help them pay for long-term care. We are also seeing more and more attention in the press, and there's been talk today about good PR, good press. Well, we've certainly seen interest coming from the media. We are getting a lot of inquiries from trade press, from state, local, and national, media outlets because this story of using a private asset that somebody already owns that they're going to throw away and instead accessing an alternative to use it to pay for long-term care is something that I think is, at this particular day and age, something that the media is very interested in. Sort of to wrap up, and this theme has come up in other people who have talked about this, we talk about it all the time. We look at this as there's three big winners in this approach that we use. First is the consumer, because again, they're taking that asset they would have thrown away. Instead, it's giving them choice. It's giving them dignity. These middle-class Americans, the people that built this country, they don't want to go on to Medicaid. They don't want to be a ward of the state. They don't want to have to go down to the poverty level and get rid of all their assets to go on to Medicaid. If they can use an asset that they own, they want to do that, and their families want to do that. This is choice. This is dignity. This is quality of care. And for the provider of long-term care services, this is a way to bring much-needed dollars into their care delivery, which provides a higher level of quality care for everybody served. It isn't just going segregated to the one person. That spreads across the entire environment. Everybody benefits. And then lastly, but certainly not least, is the states, those Medicaid budgets that are ballooning across the country, and those in all of us as taxpayers that are concerned about every dollar, and entitlement reform, and what are we going to do about ballooning budgets? Well, this is a way to delay somebody's entry onto Medicaid, and every month that we're able to keep somebody off of Medicaid and keep them private pay is a month where tax dollars were not spent on that person. And it isn't until they finish spending through this asset in this long-term care benefit account that they'll go on to Medicaid. So I'll pass the baton over to our Master of Ceremonies, stop there, and look forward to continuing this discussion.
Chris, that was great. Thank you so much. What Chris just laid out really says it all. Win, win, win. And with that in mind, state governments in particular have immediately taken a liking to saying, hey, how do we formalize this? What Life Care Funding Group does not require legislation, but the fact that states are looking to capture the savings and there's opportunity to refine the process so that individuals are aware of the option, individuals who are applying for Medicaid are aware of the option, and so that the transaction is done in accordance with good standards. There's been a real attention starting to be paid by the states. In essence, the current law, public policy in the United States says that if you have a life insurance policy when you apply for Medicaid, you have to get rid of it, in essence. It's a little more technical than that. But the public policy that we're advocating simply adds or sell, or as Chris would say, or convert for long-term care benefit. We would just say or sell. So in any event, it's a modest adjustment. And the fact that we have a regulated secondary market for life insurance, a life settlement market, it allows for that transaction to be done in accordance with those existing laws, giving consumers confidence in the transaction, giving investors confidence in the assets that they acquire. So again, with a modest change, what is really a modest change, or sell, or convert for long-term care benefit, you have an opportunity for the government to be a clear winner as well in this. So to that end, starting last year, Florida introduced a piece of legislation with the Nursing Home Association and Life Care Funding Group to look at how life insurance policies can be used to fund long-term care. That bill was deferred. In place of it was a study bill that created a work group called the Technical Advisory Work Group. I was put on that commission, on that work group, along with members of the life insurance industry, the nursing home industry, the AARP, state agencies, and a few others, to talk about how can life insurance be utilized to the benefit of all these people, all these interests, individuals, nursing homes, and the government. And the result of that, I'm going to, just a long story short, the result of that was a piece of legislation that the work group okayed at the end of December of last year, which would provide for this life insurance long-term care benefit conversion through a private network using the current state settlement laws to handle that transaction, to remove what is otherwise could be considered an impairment for somebody selling their policy, simply that if you get a life settlement, you could be automatically disqualified for Medicaid, especially if you don't spend it properly. So it puts it in, the statute would put it into a spend down account that has to be used on approved expenses at a private payer rate directly to the health care provider. And if you do that, then the amount that is received in a settlement would not be counted for their Medicaid eligibility. So it's a good private option, sort of encompasses a lot of what Chris is talking about, but matches up with the life settlement law, matches up with good consumer protections, and again, most importantly for the state, is an ability to capture that savings by measuring if we can defer people going on to public assistance, going on to Medicaid, then the state will have savings that they can measure. In the same bill, there was something called a public option, an option where the state could take over the ownership and or become the beneficiary of the policies. That was advocated, interestingly enough, by the life insurance industry. The reason for that was because they did not want to see an expansion or mandates on accelerated death benefits to help fund long-term care needs. So they said, let's go with a public option, let's promote this, because they found in Indiana and Kansas in 2011 and 2012 that a law was passed in each of those states that said the state could go into that business, could take over the ownership of the policies. So he said, let's just take on that idea, we'll let the government do it. So the bill has a public and a private option to it. That bill has been introduced last week. It cleared its first committee in Florida, and there's going to be a lot more activity on that going forward. There's a broad base of support for that bill. Again, from the nursing home groups, the consumer groups like the AARP, from Life Care Funding Group, from Coventry and other companies and other interests that are interested. The life companies are not opposing that bill in Florida, which is different than in other states, which I'll explain in a minute. But there's a real, we're very optimistic about this bill passing. The one thing that's starting to creep up, I'll just do a little foreshadowing, is that the state, there's a lot of questions, and you can imagine, if you will, Florida, public policy makers, legislators, governors going, why would we, the state, want to go into this business? It costs a lot of money to start this business, to pay premiums, to pay them on time, to service policies. So there's been a growing sense of questioning out of the lawmakers as to whether the state should do that so-called public option, but leave the private option to go forward. At the same time last year, Louisiana created a work group. Louisiana adopted a report, not legislation, that said, we want to follow what Florida was doing. That's really what the Louisiana report said. There's going to be a bill introduced any day in Louisiana that's only going to be this private option, this conversion of a life policy for long-term care benefit. In Hawaii last year, there was a study bill that didn't get all the way through. In Connecticut, there was a study bill which they didn't do anything on. So you had at least 4 states in 2012 taking action on looking at how can life insurance policies be used. And there's legislation already, I pointed out, in Florida. There's going to be a bill in Louisiana. There's already been introduced and acted on a bill in Kentucky. It passed the Kentucky House of Representatives, and it's waiting final action in the Senate with only a day to go in session. We'll see how we do. But again, it's gotten through one of the chambers in the legislature with a support from the insurance department, from the Medicaid administrator, and from legislators. It passed nearly unanimously out of the House. There's also, just in the last week, been a bill introduced in Texas, in both the Senate and the House, to do exactly this type of program. So now you've got 6 and 7 and 8 states taking it up, and without giving away the story, there's a whole bunch of other states that are looking at this, whether they'll do it legislatively or they'll do it through budget appropriations, through building into the budget, remains to be seen. All of the bills, I think, that are going forward that I mentioned, the Texas and Louisiana and some of these other states, they don't include the so-called public option. So I think this is a very exciting, turn. It's, again, focusing on a different market than most of us, other than the long in the tooth Rob Haney's of the world, have seen from the old viatical days. But you get a sense that this is getting a lot of attention and getting some momentum. I want to mention two other things. One, tax issues. Under federal law currently, a true viatical settlement, somebody who's been diagnosed terminally or chronically ill, the proceeds of the life settlement are exempt from taxation. A Medicaid applicant who's looking to enter a nursing home with a life expectancy of around 2 years, most of those transactions, or chronically ill, meaning a failure in 2 or more categories of activities of daily living, will automatically be qualified under the current IRS rules for a tax exemption. In some of the bills, not Florida because they don't have an income tax, but in some of the state bills you're going to see a mirroring of that to exempt from state taxes the life settlement or viatical, or the life settlement if it's used for long-term care, to offset the cost to government, because they shouldn't then become poor, liquidate all their assets, and then have a big tax hit because they got a windfall of $40,000 or $50,000 that they're dedicating to deferring them from going on state assistance. So it's being another incentive that may be out there for that to happen in those states where it's feasible. A little bit harder when you start bringing tax issues into it, but again, the offset of a few $1,000s potentially on the tax hit versus $40,000 or $50,000 on the deferral of their going on Medicaid is tremendously attractive to some public policymakers so far. And then just lastly, all the bills that are being talked about require what Chris mentioned, a form of what Chris mentioned from the NCOIL life insurance consumer disclosure model. All the bills are going to say that the state has to tell Medicaid applicants that they have an option to sell. The government endorsing our market. Huge, huge, huge potential. What it means is reduced headline risk, or in some cases it's been suggested, starting with Alan today, elimination of that headline risk and turning it around into positive headlines. But you're also going to see, if this market does take off, you're going to see the opportunity for this new flow of policies of the short life expectancy, although smaller face policies, which could mean a great deal for investors. A greater ability to diversify portfolios, reduction in longevity risks, and reducing liquidity risks as well. As we talk about not just the regular life settlement market, the organic life settlement market that Rob's going to now focus on, but again, this entrance doesn't mean that the whole market's going to take off. It means one part of it, but it has potential for more. But the idea that there's going to be ability for this flow of policies to help investors who would have otherwise stayed a little bit further away from the market, either because of headline risks, longevity risks, or liquidity risks, those things seem to be reduced if we start developing that market, and those policies are part of portfolios that are being acquired, are being developed. With that, I want to turn over to Rob, who I didn't really describe organic life settlements. I think it's res ipsa loquitur, speaks for itself, and let him take it from there.
Thank you, Michael, and Chris, great presentation. When you mentioned I'd be long in the tooth, Chris and you probably ate up about 75% of what I was going to say. So what I'll just say in short, in beginning to prepare for this topic, I did a lot of research, a lot of email exchanges with Michael and other people that I had reached out to about their knowledge of long-term care. And to say that it was a little better than life settlements is, I can probably say that, but it wasn't much. One of the things that I was interested in was the word crisis appeared. There's a Wall Street Journal article that came out over the weekend and many others just in this past month, all talking about this age band that's coming into retirement with very little, if any, savings whatsoever. So back to Alan's talk and Darwin's field that he built, I was in this business when the word crisis was used in the early 90s. And at the time, that crisis was HIV and AIDS. And as an industry, we were able to come together and obviously lift it up to where it is today. And while I read through a lot of the articles and listened to both of their comments that they just made, I couldn't help but see myself back there in the early 90s, that this is an opportunity for us to go out and re-educate the general public, whether that be the financial planning community, the elder law care, the consumer directly, or anyone else you could possibly think of, that life settlements are a great alternative to not only fund your long-term care needs going forward, but a whole variety of other things. So one of the things, just to kind of echo what I said earlier, is about how ill-prepared people are. There was a nationwide survey that came out earlier this month, and I want to read it so I don't lose anything. The survey polled 813 Americans aged 50 or older with at least $150,000 in income or investable assets. Of that number, only 10% have discussed long-term care with their children, 6% have talked about it with their parents, and only 23 have talked about it with their advisor, and another 45 have talked about it with their spouses. Here's the kicker. Although 24% of those surveys said they had long-term care insurance, insurance figures show only 11% of those now 55 years of age actually have such insurance. 23% are not planning for long-term care costs at all. 22% say they will take it from 401k or retirement savings, and another 21% say they will take it from personal savings. So Michael and I did a little quick math, and that kind of leaves you at zero. Is that where they're prepared? Projecting going forward, and this will be a low estimate, an average nursing home per year cost in 2030 will be $265,000 a year. And I think we've seen where estimates go from people who've done surveys of what things will look like if we just paid attention to the fiscal cliff and the sequester recently, that they're never the same. So what brings me back, full circles, what is organic life settlements? What is it that I do as compared to what Chris does? And quite honestly, other than he gets people to call him directly without any advertising, is we educate people in a myriad of ways. And I've actually implemented this in my office 2 weeks ago when I knew I was going to be here. And I said, I want you to call up your advisors who you've had conversations with over the years, and I want you to talk to them about long-term care and what they know about it, what they're doing with it, what their clients plan to do with it, and it kind of mirror images some of the statistics I just read to you. They're not talking about it. They said long-term care doesn't work. Everyone's dropping out of it. I mean, you mentioned some names. It's the laundry list of who's left is there's not many. And some people, some of the horror stories were that when people actually get to the point where they want to utilize the long-term care, it doesn't cover the things they wanted to cover. So in many cases, they don't qualify for this, they don't qualify for that. So it's broken, and I think we have an opportunity to fix it. So that's really what I have to prepare, and I would hope we'd have some questions because I think we could probably answer those.
Rob, just from our conversations, where did this is the long-term care market, but how do you see what the approach back to the producer community, back to the financial advisor community? Does this create opportunity for large face policies, longer LEs, the traditionally organic life settlement market?
Well, just to go back what I said, when we had the conversations around our office with our advisors, they had never actually put the two together. They never really saw this as you could take the settlement proceeds and use that for long-term care. So that's one of the new things that we're gonna bring forward. But I'm sure there's 100 other ways you can approach it.
So it's an opportunity not just to educate them about selling their policy, but even taking out life insurance.
Sure, I think there's others that have mentioned that that's their long-term care plan. They look at the long-term, the organic life settlements. To use Michael's frame, this is their new long-term care plan. They're going to go out and buy life insurance when they're in their 50s and maybe even early 60s, and then pay that policy moving forward, and then hopefully settle it. Now, I don't know if that'll work or not, but I can tell you one thing, it seems to be a lot better than the alternative, which has been the long-term care policies that I've seen and investigated.
Are there questions? 1, 2. Will?
Scott?
Wes. Oh, we've got it.
Isn't there a minimum amount of assets that someone can have and be pledged toward their burial? Maybe $10,000, such that they could take the cash value out of that and put it in an annuity that's designated for burial purposes. That's one situation. The other is, it seems like what y'all are talking about would be larger face policies with larger cash values or larger settled values, and I question whether or not those are good candidates in the Medicaid. It seems like there's a disconnect there. Once again,
Take the first one.
I may be completely off base here.
Regarding the size of the policies, think of it like 3 different tiers. You have truly poverty level people. They don't have any life insurance, and they're going to go right on to Medicaid. That's what Medicaid is designed to do. Then you have the high net worth, the people that have 7-figure death benefit policies, multi-million. Those are people that have planned for long-term care for the most part. They either have the liquid ability to cut those checks every month and move into a nice assisted living or stay home with home health care. They may have also long-term care insurance, got a really, a platinum plus long-term care insurance policy, not a standard grade, that really has, a lot of options that it'll cover. The consumer we're working with is the middle-class Walmart shopper with a $100,000 life insurance policy, a $50,000 life insurance policy, a $200,000 life insurance policy. That's a person who is can't just afford it and isn't going to just automatically go on to Medicaid. They're trying to figure out what they're supposed to do to spend down their assets to get on to Medicaid. And that's where the life insurance policy is going to count against them in one of 2 ways. If the life insurance policy has more than a minimal amount of cash value, typically between $1,500 and $2,000, the state wants you to surrender it for that amount. Let's say it was $3,000 of cash value on a $100,000 life insurance policy. The state would want you to surrender it, take that $3,000, spend it down on care, and then you go on to Medicaid that month. But instead, by converting it, you may extend their ability to remain private pay 12, 18, 24 months. And the way the benefit is configured and administered, it is specifically designed to be a Medicaid qualified spend down. And then to your point of exemptions, every state has certain exemptions, particularly for funeral policies every state has a different way of doing it, but those are very small. Those are $5,000, $10,000 policies. We have always made sure that we maintained a funeral portion in that benefit amount as part of the benefit to the family.
Take the floor.
Well, this is, basically a life settlement that's being paid out in periodic payments, which does raise some issues
No,
with regard to the legislation.
no, it's not installments. It's all paid out front, put into an account, secured, day one. The entire amount is locked up, paid out, day one, and then administered at the direction of the person to pay for their care through a third-party benefit administrator.
Okay, so the investor pays the lump sum. So to the investor side, it's just like a regular life settlement. They get the policy, they pay their full amount, and they pay the premium. Who administers the money on behalf of the seller, policy seller? And are they regulated? Do they have to have a certain credit worthiness?
We have a certain way of doing it to make sure that it's regulated and that it is a Medicaid qualified spend down.
The work group in Florida, and therefore the legislation in Florida that's now being followed in other states requires it to be in a bank, in a licensed state or federally chartered institution. So with direction as to how that money is to be spent. So it's directly to the healthcare provider. So you've got the additional incentive that the healthcare providers can make sure they get paid. That's not going to be a box full of receipts and I've spent it properly. It's dedicated in that regard, and that's what came out of the work group.
Are they in segregated accounts for each settlement?
I think they'd have to be, but again, the legislation just requires that lump sum be put into an account.
Good deflection. Mayor.
The evaluation of the policy evaluation is done basically same way as a life settlement transaction. In other words, you take into consideration the life expectancy of that person to evaluate premiums to be paid and so on, and based on that you evaluate how much money you put aside for long-term care. Second question, the long-term care could be substantially longer than 2 years, and you guys are talking about 2 years LE. Explain to us how that works.
Again, I think everybody would have a different way of how they value and evaluate, so I couldn't really speak to, I'm sure if you're an investor, you would have a certain way that you would go about doing it.
On a national basis, if you're on Medicaid and in a nursing home, the average stay in a nursing home is just about 2 years, just under 2 years. As a member of the Florida Work Group, the agency that oversees Medicaid in Florida showed that the average stay in a nursing home for a Medicaid recipient in Florida is just over 1 year. Now, I'm just going to extrapolate. Not everybody dies, but most do. If they're on Medicaid and they're in a nursing home, the length of stay in that nursing home is under 2 years.
So the idea is then to do the transaction when the person is ready to go to a nursing home, not before that.
Not necessarily. It can be home health care, it can be assisted living, it could be independent living. We have supported care of every variety and a whole range of life expectancies.
Yeah, I just gave a nursing home example, but obviously the legislation, and I can't talk about Chris's program, but the legislation is focused at the point of application for Medicaid. And, as Chris said, assisted living is not funded by Medicaid. So you're talking about nursing home or maybe some home health care, and that's an area that's getting cuts in budgets even worse. Actually, nursing home is becoming the default choice, at least I think it is. It seems to be. So again, there's just some information for you, but everyone's going to have to look at it themselves, what that target market looks like.
But basically, we're talking about people with a very short life expectancy that will be candidate for the transaction that you're proposing, correct?
Generally, yeah.
It'll match what is typically the expected range as it relates to a different form of care. I mean, a person with Alzheimer's could live a decade.
Thank you.
We'll get you next.
No,
Go ahead.
Is the retained death benefit a mandatory part of this program, or will you have programs that will not have the retained death benefit portion?
Any irrevocable beneficiaries are you talking about?
No, I thought you meant like the family is still entitled to some portion of the death benefit.
Well,
Is that a part of the
carved out?
program or not
as
necessarily?
part of the legislation, there's a requirement that a percentage or a maximum of $5,000 is retained for funeral, for burial needs, and then any amount that's left over in that account has to go to a named beneficiary or the individual's estate.
Okay.
Again, that's just the legislation that I'm talking about. Nothing that is passed yet.
That doesn't mean that that the purchaser will have an additional beneficiary in the policy, because the policy will be settled.
Right.
Do you expect there to be additional regulatory requirements or infrastructure from the buy side, right? The provider, in a viatical transaction, there are additional disclosures and forms required, so on and so forth. Do you expect that there'll be a different track on which these transactions would be executed as life settlements by providers, different forms and standards by which they can buy these assets?
I think that, again, speaking to the Florida legislation and some of the bills that are starting to evolve out of Florida, really not very many additional requirements, nothing substantial. Oversight of those transactions by more than one agency, the insurance regulator and now the Medicaid regulator. But in terms of the transaction, it should follow most of the same, if not all. It's supposed to follow all the same current settlement law requirements. From the provider standpoint, additional requirements may be some advertising and marketing if the state doesn't already require it. But if they do, as most do, it won't be additional requirement.
I'll just add this. The one thing you have to bear in mind is the two most highly protected classes of people in this country are babies and seniors. And so you have to operate at such a high level ethically to deliver this, because there is so many watchdogs around the long-term care delivery system in this country. There's as Michael pointed out in the legislation, you're now dealing with dual regulatory oversight. but then they're layer after layer after layer inside the state, long-term care ombudsmans, semi, quasi-funded senior rights groups that get some state funding. There's the level we need to operate at to satisfy this marketplace is at an extremely high level, extremely high level.
I guess there's one last question that somebody had.
Actually, I think you maybe answered it with Jolene's question, but, so, it's almost like this gets set up as in like an HSA or something at the bank, right? And in the event that the insured were to die 6 months into, the time and there was cash still in the account, you're saying that that could still be distributed back to the family, or just maybe go towards like a estate tax credit or something, or?
No, again, the legislation is written so that the money, any leftover amount, because remember, the settlement transaction is already set up, has been completed, that lump sum's been paid, that account has been set up. Anything left over by statute would be directed back to a named beneficiary of that account, not of the policy, of that account, or their estate, I think. But I think the forms will have to require that be done. If there's more questions, we can take later, but I think time for us to get off the stage. Great. Thanks.
Thanks.
Good. Asking your questions.